Welcome to the Well-Rounded Retirement Podcast with John and Jim from Chris Financial. In this podcast, we help you take a well-rounded approach to retirement planning so you can retire with complete certainty. If you're looking for proven and straightforward retirement advice, ranging from how to protect your assets to how to spend with confidence, this show is for you.
Hello and welcome to Well-Rounded Retirement with Jim Donewald and John Glowaz from Chris Financial. Now, John is not on the podcast today. Jim is steering the ship. Good morning, Jim. How are you?
Good morning, Eric. How you doing?
I'm excited. You've brought a guest on, and it's the first guest that you've had on your podcast. Are you excited?
Yes, I am excited. We have David McKnight, our author, and he's actually been kind of a mentor here to us at Chris Financial on the rising tax rate environment.
Yeah, and you've given me the honor of introducing him just a little bit. I cannot possibly give a good bio for this guy. I mean, let's just be honest. Audience, you're going to hear a ton during this podcast. Let me just do a brief introduction here. David McKnight graduated from Brigham Young University with honors in 1997. And over the past 22 years, David has put thousands of Americans on the road to 0% tax bracket. And if I listed all the places he's made appearances, including Forbes, USA Today, New York Times, that would take the entire podcast. So I'm not going to do that, but you understand what I'm saying. His best-selling book, The Power of Zero, has sold over 250,000 copies, and he's got other books that they're going to be talking about today. So without further ado, David McKnight, thank you so much for coming on the show today.
You're welcome. It's an honor to be with you today.
Well, Dave, I don't want to take up a lot of your time here because I know you're a busy man, and I appreciate it. So I want to kind of just jump right in here. And I wanted to start with one of the basics, which is what got me started and started kind of following your program. And that was your book, The Power of Zero. Can you tell us briefly what prompted you to write that book?
Well, if you study history a little bit, you know that in 1997 we had a budget deficit of zero. I mean, Bill Clinton stood before Congress and he says, "Hey, I've got some great news. Our fiscal deficit is simply zero." And here we are, 20 years later. The fiscal deficit is over $1 trillion. That was pre-COVID-19. We have $27 trillion of debt, and the debt will grow by between $4 and $6 trillion in 2020 alone. So this sort of sets the stage for all of the fiscal crises that are facing our country. Anyway, back in 2014, I sort of saw the handwriting on the wall in terms of the national debt. And I wanted to write a book that sort of laid out all of the fiscal pressures that are facing our nation and talk about what people could do in terms of preparing for their retirement and insulating themselves from the reality that tax rates in the future are going to be much, much higher than they are today. I'll tell you a quick story. You know, I do about 90 presentations per year. That was pre-COVID-19, live and in person all across the country. And I routinely ask rooms full of people, hey, how many of you guys think that tax rates in the future are going to be dramatically higher than they are today? And you know what? Every hand in the room goes up. And you know what? Every single one of those people can tell me exactly why they think tax rates are going to go up. And then I asked this follow-up question. How many of you guys have the lion's share of your retirement savings situated within a tax-deferred account like a 401k or an IRA? And every single hand in the room invariably goes up. And so I noticed that there's a massive disconnect between what people think and what they're actually doing about it. If you really truly thought that tax rates in the future are going to be dramatically higher than they are today, then you would be saving all of your retirement dollars in the tax-free account. But that's not what Americans are doing. I wanted to write a book that lays out a case for tax-free investing, lays out a case for why I think that tax rates in the future are going to be dramatically higher than they are today, and specific strategies that Americans can implement starting right now before tax rates go up for good.
Well, you know, I wanted to ask you a couple of questions. All our clients, by the way, we've given your book to all our clients, and I think it's been a tremendous help. But one of the questions I get a lot for those that haven't read the book, you know, one of the things we're trying to do is move this income to the tax-free bucket. One of the first questions I always get, though, if I've got a sizable pension and I know I can't get down to the 0% tax bracket, does it still make sense?
Yeah, so I tell people, look, worry about the things that you can control. Don't worry about the things that you can't. I've often used the analogy of a tax freight train that's bearing down on your 401k or IRA. Your money's sitting on the tracks. We know when that tax freight train is going to arrive. We know the impact of that tax freight train. So what I say is let's get the dollars that we can control systematically shifted off the train tracks before tax rates go up for good, before that tax freight train arrives. So we've got about 6 years before that freight train arrives. So let's worry about the things that we can control. We can control your IRA or your 401k. If you have a pension and you don't have what we call a lump sum distribution option, that means that you're not ever going to get to the 0% tax bracket. That money will always be exposed to the impact of higher taxes. You will probably always be paying taxes on your Social Security as well. However, that doesn't mean that you have to resign yourself to paying high levels of taxes on your 401ks or IRAs. You can get those dollars repositioned off the train tracks into tax-free accounts where they're insulated from the impact of higher tax. So I sort of tell people, look, let's divorce your world into the things that we can control and the things that we can't control. We can control the dollars in 401ks and IRAs. Let's worry about that and get those dollars protected from the impact of higher taxes.
Well, under that scenario, it doesn't always make a stronger case then if you do have a sizable pension that getting that money, the rest of the money that you can out of the tax deferred bucket makes more sense. Isn't this probably going to be the best tax marginal tax rate they're going to be in?
Yeah, no question about it. So if you think about the American tax system as like that graduated cylinder from chemistry class, your taxable income flows into that cylinder. Some of your money gets taxed at 10, some at 12, some at 22, some at 24, some at 32, some at 35, some at 37. If you have a pension in retirement, it's going to cause likely up to 85% of your Social Security to be taxable. So that means your pension and the taxable portion of your Social Security are probably going to fill up the 10 and 12% tax bracket. Any money that you take out of your IRAs or 401ks are going to flow into that cylinder and be taxed right on top of those other dollars, probably at the 22% tax bracket. So 22%, that means best case scenario, you own 78% of your 401k or IRA right now. If you're currently in the 22% tax bracket, why would you let a single year go by where you're not converting money from your tax-deferred bucket to the tax-free bucket up to the top of that 22% tax bracket? And by the way, the 24% tax bracket's only 2% worse. So why not convert up to the 24% tax bracket each and every year before tax rates go up for good? So you make a great point. We absolutely, if we know that there's going to be a pension in play in retirement, we should absolutely have a sense of urgency in terms of getting dollars repositioned from tax deferred to tax free each year between now and 2026 when tax rates go up for good.
So what about the opposite? What if you don't have a lot of your funds in the IRA? Let's say you're lucky enough that you've paid taxes on most of that. Why is that so inefficient, just to keep it all in the taxable bucket?
Well, your taxable bucket is the least efficient of all your buckets. And think about it this way. How much money can you put into a Roth IRA? You can put in, if you're over age 50, you can put in, $7,000 per year. How much could you put into a 401k? You can put in, $26,000. That's in your tax deferred bucket. How much money can you, if you won the Powerball lottery, could you put every last dime of those dollars into your taxable bucket? Sure, you could put $1 billion in your taxable bucket. Why is the IRS so forgiving when it comes to how much money you can put into the taxable bucket? Well, it's because that's where they make the most money. They would love nothing more than for you to have the lion's share of your net worth within that taxable bucket. How do we know that? Because there's no limits on how much you can put into that bucket. So it's the least efficient of all buckets. So a person who has the lion's share of their assets in the taxable bucket has even more urgency to take advantage of the tax-free bucket. When we run our mathematical before and after comparisons, showing people growing and compounding their net worth within the taxable bucket versus the tax-free bucket, the difference is like night and day. So they should have even more urgency than the person that has all their money in the tax-deferred bucket.
Well, Dave, as I said before, I've read all your books, and I noticed that whether it's The Power Zero or Look Before You Lerp, you always stress that it's important to have multiple streams of income to get to the zero tax bracket. Can you explain why that's so important?
Yeah, I typically advocate between 4 and 6 different streams of tax-free income. And the reason I do so is because every single one of those streams of tax-free income has a different advantage. And I'll go through them one by one to just give you an idea of what I'm talking about.
Please.
I love the Roth IRA, just the traditional Roth IRA. You can put in $7,000 per year. The thing that's great about that Roth IRA that distinguishes it from all of the other tax-free investments is you can put that money in and you can take it right back out. So it has 100% liquidity from day one. I love the Roth 401k because you can put after-tax dollars in. It grows tax-free. But you can also get a match from your employer. So you get free money from your employer. None of the other tax-free investments have that particular attribute. I love Roth conversions because you could have $1 billion in your IRA and you could shift every last dollar of it to your tax-free bucket. Roth IRAs can be the real workhorse, can do a lot of the heavy lifting in getting dollars repositioned from tax-deferred to tax-free. And by using the Roth conversion, you can get your IRA or 401k down to the ideal balance in your tax-deferred bucket. Most people think the ideal balance in your tax-deferred bucket is zero. It's not. For most married couples who don't have a pension, you probably want to keep about $350,000 in there because it will create an RMD by the time you're 72 that is equal to or less than your standard deduction, which means that you can actually take money out of your IRA tax-free. And that's what I call the holy grail of financial planning because you got a deduction on the front end, it grew tax deferred, and then you took it out tax free. And there isn't anything else out there besides a health savings account that has that particular attribute. And we talk about in chapter 5 of my book, The Power of Zero, I talk about the LIRP or the life insurance retirement plan. And that allows you to grow money safely and productively in a tax-free environment, but that it also has a death benefit that doubles as long-term care. Most people, long-term care is one of the most dangerous risks in retirement that we'll face. People aren't opposed to having long-term care insurance. They're just opposed to paying for it. Nobody wants to pay for something they hope they never have to use. Die peacefully in their sleep, never having used it, and then the benefit goes to somebody else. What happens with the LIRP is that these life insurance companies will give you your death benefit in advance of your death for the purpose of paying for long-term care. And if you do die peaceful in your sleep 30 years from now, never having needed long-term care, someone is still getting a death benefit, probably your kids. So there isn't that sensation of having paid for something you hoped you never have to use. And that is an attribute that none of the other tax-free vehicles have. And finally, if you have all these streams of tax-free income and you can stay below your provisional income thresholds, which is the income the IRS tracks to determine if they're going to tax your Social Security or not, which is $34,000 for single people, $44,000 for married couple. That shields you from having to pay tax on up to 85% of your Social Security. Then your Social Security can also be tax-free. So we're talking 5 or 6 different streams of tax-free income. They all have different attributes, but they all can play a crucial and central role in your tax-free retirement plan.
Well, I was going to ask you what the 10,000-foot view is, but you just gave it, so I appreciate that because we throw the LIRP term around, and for those that haven't read the book, which I encourage them to, it's just one of the tools we use to help. When you talk about the LIRP, David, which I'm a fan, but I know there's some costs involved in that, and that's one of the questions I get all the time that we handle at our firm is, well, insurance is expensive. So how do you explain that?
Well, it's not if it's not that expensive if you consider the expenses as an average per year over the life of the program. Dave Ramsey loves to say, hey, life insurance is expensive. Look at what you're paying the first year. Well, I could flip that on its head and say 401ks are expensive. Look at what you're paying in the 30th year. So, for example, you have $1 million in your 401k and they're charging you 1.5%. That means they're charging you $15,000 per year. That's a lot more expensive than any life insurance policy I've ever seen, typically within the types of amounts that we advocate for. If you consider that life insurance, we don't look at what the expenses are in the early years. These are front-end loaded products, meaning the insurance company incurs a lot of expenses to get these programs off the ground. What I say is, look, if you're planning on keeping this LIRP for 30 years or longer, why fixate on what the expenses are in the first, second, or even fifth year? Let's look at what the average expenses are over the life of the program. And when you average out the expenses over the life of the program, you look at the internal costs over a 30 or 40-year time frame, this is actually much more economical than most investments you find out there. Certainly more economical than your 401k. What you'll find is that the longer you keep the LIRP, the more economical it becomes. Generally speaking, the LIRP is going to cost you about 1.5% per year on average over the life of the program. It's going to be a little bit more in the early years, much, much less in the latter years. But when you average it out over the life of the program, it's going to cost you about 1.5% of your bucket per year. So that compares very favorably with a 401k or an IRA. And guess what? The longer you keep the LIRP, the more likely that internal expense can go from the 1.5 all the way down to 1 or even 50 basis points. So I think that it's a myth that these programs are expensive. If you fixate on what the costs are to get the program up and running, certainly you could make the case that they're expensive in the first couple of years, but it averages out to be a very economical accumulation tool when considered over the life of the program.
Well, I think you've said before too, expensive, compared to what? What else are you going to get these kind of advantages? Where else in the market? Where else are you going to get this return protection? Some kind of floor on your growth, which also brings me to the point. One of the other things that we kind of put in the plan that we always want to make sure clients have, because in this age, almost nobody's got a pension anymore. And I know one of the things you kind of stress, and we stress at our firm, is some kind of pension protection plan or some kind of guaranteed income stream. Can you tell our listeners why this is so important as well in our retirement?
Yeah, they do all of these surveys of retirees and pre-retirees, and they say, hey, what is your biggest concern, for retirement? And the number one concern over and over and over again is this idea that you're going to run out of money before you die. And so one of the things that you can do is it's what we call longevity risk, and we try to mitigate longevity risk. And there's really two ways that you can go about mitigating longevity risk. The first is it's what's called the probability-based approach, which says if you accumulate enough money, you'll have so much money that you can weather the ups and downs in the stock market. And historically, they've said if you take out up to 4% of your retirement nest egg per year, you'll have a very high probability of never running out of money prior to life expectancy. The problem is over time, that number has been downgraded to 3%, and some people say even 2.5%. So to give you an example, if you need to spend $100,000 above and beyond maybe what your Social Security is providing, divide 3% into 100,000. That tells you need $3,333,333 to be able to have an 85% likelihood of never running out of money before you die. That's a lot of money, and a lot of Americans aren't prepared to save that. And so there's a second approach, and that's by using an annuity, which in some circles is a very verboten term, which basically says, let's offload this longevity risk to an insurance company whose job it is to mitigate that risk. So in other words, you could hand over a corpus of money to an insurance company, and in return, they will give you a guaranteed lifetime stream of income. It's guaranteed to last as long as you do. And typically it's much more economical to do it that way. It costs about half as much money to get the guarantee that you'll never run out of money that way. And so typically annuities are the best and most efficient way to mitigate longevity risk. The problem is most people try to mitigate that risk within the tax-deferred bucket. And in a rising tax rate environment, that's never a good way to approach it.
I think that's an excellent point. And that's certainly the philosophy we follow. And I think one of the things you were talking, one of the podcasts I was listening to, you talk about, the longer you live too, the way it magnifies all these risks. Can you touch on that a little bit? So if I live longer, what's the likelihood, I guess, of me to get the LTC, needing some kind of health issues?
Yeah.
How does that work?
So there's an array of risks that you face in retirement that are magnified by longevity risk. Inflation risk, sequence of return risk, long-term care risk, distribution rate risk, withdrawal rate risk. These are all magnified. Essentially what it says is the longer you live, the greater the likelihood that one of these risks will strike a lethal blow to your portfolio. So longevity risk is the most pernicious of all risks because it magnifies all of the other risks that you face in life. In other words, the longer you live, the more likely you are to have an encounter with one of these risks that could bankrupt your portfolio. All the more reason to completely eliminate longevity risk from your retirement portfolio by getting some guaranteed lifetime, inflation adjusted, and if we really have our druthers, tax-free streams of lifetime income.
Well, that reminds me of, I'm going to plug one more of your books here, The Volatility Shield, which actually I just got finished reading that but a couple of weeks ago. It's kind of the story of a gentleman going through his retirement with plenty of money, or so he thought. You want to touch on that real quick? The premise of that book, kind of.
Yeah. So the basic premise of that book is it's a story of a guy who flies into town because his father-in-law has a health crisis, and the things that he comes face to face with cause him to reflect upon his own financial situation, and he begins talking to a financial advisor. And she runs some numbers on him, and he realizes that he's not going to have enough money to reach, to be able to retire when he wants to. And so she lays out what his options are. He can save more, spend less, work longer, die sooner, or take more risk in the stock market. So he's got one of those choices, and he doesn't like any of those choices. And frankly, most Americans don't like any of those choices. So she lays out, with some coaxing from his end, she lays out a sixth option, which is basically to create an account that I call the Volatility Shield. And the Volatility Shield, the premise is this: the reason why Americans have to save so much money for retirement is because they're going to experience some down years in the first 10 years of retirement. And because they're going to be forced to take money out of their stock market accounts during those down years, it's like kicking your portfolio while it's down. That act alone of taking money out of your portfolio while it's in a down market can literally bankrupt your portfolio, which is why you have to save so much more to account for those types of scenarios. And so what this financial advisor says is, guess what? We know that you're going to have 2 to 4 of those years in the first 10 years of retirement. Why not accumulate money in an account that's safe and productive and tax-free that would allow you to pay for your living expenses during those 2 to 4 down years in the first 10 years of retirement, so that we're not forced to take money out of our stock market portfolio and we give it a chance to recover. And what she shows them is that if you have an account like that in place, which I later revealed to be the LIRP, if you have an account like that in place, you are no longer constrained by the 4% rule. You can now take distributions out of your stock market portfolio, 7, 8%. In some scenarios, we've seen even as high as 10%, because you're not constrained by that 4% rule, because you are not putting yourself in a position where you're required to take money out of your stock market portfolio during a down year.
Well, I like that a lot better than trying to save $3 million in the short period of time I have left to work. But
Right.
That sounds like a much better way.
Right, exactly.
I wanted to save the best for last year. I want to thank you. First of all, I got an advanced copy of this book, and I know it's coming out shortly. I'm not exactly sure when it'll be released, but the Tax-Free Income for Life, which I know is kind of a step-by-step process, which brings this all together. But why don't you tell our listeners a little bit about that, please?
Yeah, so historically, financial advisors have been very adept at mitigating either longevity risk or tax rate risk. And tax rate risk, of course, is a risk that tax rates in the future are likely to be higher than they are today. And we do that by shifting money from tax-deferred to tax-free. So advisors have been very good at mitigating either longevity risk or tax rate risk, but never both within the same retirement plan. So for example, it's very easy to mitigate longevity risk. You just get a guaranteed lifetime income annuity, stick that in your tax-deferred bucket. The problem is, if you draw that income out of your tax-deferred bucket, it exposes you to two risks. It exposes you to tax rate risk, and it exposes you to the risk that your Social Security will be taxed. Both of those things can force you to spend down all your other stock market assets 10 to 12 years faster. And so what tax-free income for life does is, I think in a relatively groundbreaking way, is it shows how you can mitigate both of those risks within the very same financial plan. And you basically do so by what I call a piecemeal internal Roth conversion, which very few annuity companies allow you to do these days. And so the basic idea is that you contribute money to an annuity that's going to give you that guaranteed lifetime income. But before electing the guaranteed lifetime income, you do a piecemeal internal Roth conversion to a Roth IRA. In other words, little by little, year by year, you shift the money within that annuity from the tax-deferred bucket to the tax-free bucket, but it all happens within that same annuity. So by the time that conversion is done, you now are in a position where you can elect to receive that guaranteed inflation-adjusted lifetime income from your tax-free bucket. So consider that, having a tax-free stream of income that's insulated from tax rate risk. It doesn't count as provisional income. It doesn't cause Social Security taxation. You've now plugged some of the biggest potential holes in your retirement picture. And so I think that a lot of advisors out there are good at doing one or the other, but not both. They're mitigating tax rate risk to the exclusion of longevity risk or vice versa. And what this book does is it lays out a step-by-step process where you can mitigate both within the very same financial plan.
Well, I like it. I think you said it's a very good holistic. As I've grown in our practice here, you keep getting new ideas. That's part of our job, is to constantly be out there and be on the lookout for what's happening and what our clients need now. And I will tell you, I think this is one of the best plans as far as all encompassing all these different risks that kind of come at us. So I really appreciate your time today. I know we've jammed a lot in there. Eric, how are we doing?
Oh, you guys are doing fantastic. This was, wow. Drinking from a fire hose is the statement that I would say. David, wow, you were a fantastic guest. You want to kick off this podcast as the first guest. Now you've set a really high bar. So
I apologize to subsequent guests.
That's right. But I want to speak to the audience just for a moment, because I was just absolutely fascinated by, there's so many strategies. Jim and John and I have talked about this before, the strategies that they use with their clients, and everything's individualized. We get that. But for you listeners, I just want you to understand something. During the time that you've been listening to this podcast, the U.S. debt has increased by $72,265,044. They're going to want that money back somehow. And there's not a ton of ways to get that money back. So the time we listen to this podcast, that's $72 million bill is going to somebody. And so taxes are incredibly important. Wow. David, thank you again so much. And I love the fact that we can rewind this, because I'm going to have to listen to it a few times. And I was here live with you guys. So fantastic stuff.
Yeah, I think I know who they're going to for that bill, by the way. I think I know where they're going for that.
You have an idea, huh?
Yeah, I got an idea. I got a strong idea. Yeah.
Strong idea. Oh, man. All right, gentlemen, thank you so much for your time today. This was a fantastic podcast.
Thank you for having me.
Thanks, Eric.
All right, and the last thank you goes to you, the listening audience. Thank you for tuning in and listening to the Well-Rounded Retirement Podcast with Jim Donewald and John Glowas. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim and John come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Chris Financial, this is Eric Johnson reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Well-Rounded Retirement Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Chris Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.